Ever pondered over the question, what is accounting and why does it hold such significance? Well, it's time to unravel the mystery. Accounting is a systematic process of identifying, recording, measuring, classifying, verifying, summarizing, interpreting, and communicating financial information. Its primary objective is to provide relevant financial information about economic entities to various stakeholders, enabling them to make informed decisions. It's the language of business that communicates the financial health of an entity. Now, let's dive into some of the fundamental building blocks of accounting. Debits and credits. The concept might seem daunting, but it's surprisingly simple once you get the hang of it. Imagine a seesaw. On one side we have debits and on the other credits. For the seesaw to balance, the total weight on both sides must be equal. Similarly, in accounting, for every transaction, total debits must equal total credits. This is the golden rule of accounting, ensuring the accuracy of financial statements. Debits and credits are fundamental concepts in accounting used to record transactions in the double-entry accounting system. In this system, each transaction affects at least two accounts, with one account being debited and another being credited. Here's a simplified explanation. Debit. When an account is debited, it means an entry is made on the left side of the account. Debits are typically used to record increases in assets, expenses, dividends and losses, and decreases in liabilities, equity, and revenue or income. Credit. When an account is credited, it means an entry is made on the right side of the account. Credits are used to record decreases in assets, expenses, and losses, and increases in liabilities, equity, and revenue or income. In essence, the double entry system ensures that for every debit entry, there's an equal and opposite credit entry, maintaining the accounting equation, assets equal sign liabilities plus equity. This system helps ensure accuracy in recording transactions and maintaining the balance of the accounting equation. So what exactly are debits and credits? In the simplest terms, debits increase assets and expenses, while decreasing liabilities, equity, and income. Conversely, credits increase liabilities, equity, and income, while decreasing assets and expenses. It's like a game of tug-of-war. When you debit an account, you pull it towards the increase side, and when you credit an account, you pull it towards the decrease side. Let's take a scenario. Suppose a company purchases a machine worth 10,000 pesos. Here, the asset account, machinery, increases by 10,000 pesos. So it's debited. On the other side, the company's cash decreases by the same amount. So the cash account is credited. Now let's consider another scenario where a company earns revenue of 5,000 pesos. Here, the cash account increases, so it gets debited, and the revenue account also increases, so it gets credited. But why do we use debits and credits? They provide a structured method to record transactions, ensuring that the financial statements are balanced. Debits and credits help in tracking the flow of resources and obligations among different accounts, thereby giving a clear picture of a company's financial position. To remember when to debit or credit, here's a handy tip. Dealer. D for dividends, E for expenses, and A for assets, which all increase with debits. L for liabilities, E for equity, and R for revenue, which all increase with credits. So, in a nutshell, accounting is a crucial business function that aids in financial decision-making. Debits and credits form the backbone of accounting, ensuring the balance and accuracy of financial statements. Remember the dealer mnemonic, and you'll have a firm grasp of when to debit and credit.